आपको इशारा कर देना, शुरू कर देना, फिर नीचे कर देना, 2-4 सेकंड रुकना, फिर अपना स्टार्ट। हेलो, ठीक है ठीक है ठीक है, हाँ भाई सब ठीक है।
इसका रवि का ऑफिस कहाँ पर है?
सभी को पता है।
ये ब्लॉक में है ना, वहाँ कहीं जाकर IIM वाली रोड के ऊपर, तो IIM तो इधर है,
उससे आगे वाला रोड है, उससे अगला वाला जो रोड है ना, लेफ्ट हैंड।
Good morning, learners and viewers. Today's program is MBA, course code MMPC 004, Accounting for Managers. Introduction. Accounting is a language of business. The basic function of any language is to serve as a means of communication. So, accounting is also for communication of business to the users. The definition accepted by the common people is accounting is the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions and events which are in past at least of financial character and interpreting the results thereof. The another definition is less than restrictive, interprets according as the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by the users of information. The objectives are to ascertain profit and loss, to determine the financial position, to provide information to the various users, and to assist the management by analyzing financial data and providing interpretations in the form of reports. Accounting assist management in handling business operations effectively. This is the chart, scope of accounting, how the data is collected, creation, then historic data and predictive data. Historic is the which has happened in the past, data recording, then identifying, classifying, accounting methods, then analyzing and reporting to the external as well as internal. External users of the data are the shareholders, the creditors, the employees, investors, and government and public at large. Then scope of accounting, data creation and collection is raw material for accounting. The data collected is historic in the sense and refers to the event which have already taken place. Earlier accounting was largely concerned with the what had happened rather than the making any attempt to predict and prepare it for future. After the historic data has been collected, it is recorded in accordance with generally accepted accounting theory. A large number of transactions or events have to be entered in books of original entry, which is called journals, and then it is posted to the ledgers in accordance with the classification of the scheme already decided. The recording and the processing of the information usually accounts for a substantial part of accounting work. This type of activity, accounting, may be called as recording. The processing method employed in the recording may be manual, mechanical, electronic, or through computer. Then data evaluation. After that, it includes the controlling of activities, business with the help of budgets, standard costs, evaluating the performance of business, analyzing the flow of funds, and accounting information, decision-making purpose by choosing among alternative course of action. The analytical and the interpretive work of the accounting may be internal, external users, as may be making. Then data reporting. It consists of two parts, external and internal. The external reporting refers to the communication of the financial information, earning of financial data and fund position about the business. Outside parties such as shareholders, government agencies, regulatory bodies of the government. Internal reporting is concerned with the communication of the results to the financial analysis and evaluation to the management for decision purposes. Then definition of accounting as a process of reporting, recording, interpreting, and summarizing economic data. The introduction of accounting helps the decision makers of a company to make effective choices by providing information on the financial status of the business. Accounting is a system which identify the transaction, record those transactions in a business organization in a way that can be compared with the other business as well as with the business with the help of past performance. Accounting is part of our daily life. A person most common use of accounting is to check the accounts, tax forms, payrolls, and credit taken. All these experience focus on record keeping part of accounting. Nowadays, due to advancement of technology, the recording part is done with the help of technology. Still, the analysis is done by the human minds. The understanding of various concepts of accounting is an important. To understand accounting efficiently, it is important to understand the following aspect of the accounting. One is the economic data. These are the result of the consequence of monetary transaction which company has to undergo during the lifetime, such as purchasing new machinery, raw material, transportation machine, installation on site, etc. Identification and measurement, recording and communication. The purpose of accounting system should be elaborated in such a way that the right data is identified, measured, recorded, and communicated to the right individual and at the right time. Then assets are those resources owned by the organization which has the company earned profit. The economic value of an item which is possessed by the enterprise is referred to as the asset, like plant and machinery, furniture and fittings, land and buildings, books, computers, motor vehicles, finished cash and investments. Assets can be tangible and intangible. The tangible assets are those which have physical form, which can be touched, like plant and machinery, land and building, furniture and fixtures. And intangibles are those which do not have physical form, like goodwill, patents. Liabilities are the obligations of the company or business concerned. Responsibility are that are arise out of breach transactions, which is payable by the enterprise through though it purchased by the enterprise. Liabilities can be classified fixed and current. For example, outstanding expenses, debentures, loans from the bank and the financial institutions. Owner's equity is one of the three vital segments of a sole proprietorship balance sheet, and one of the main aspects is accounting equation. Assets are liabilities plus owner's equity. It represents the owner's investment capital in the trade minus the owner's withdrawal from the trade, drawing the net income since the business concern is commenced. Accounting cycle. Identifying financial transactions and events. Only those transactions and events which are of financial nature. Therefore, first of all, such transactions and events are identified. These are recording of transactions. Accounting involves recording of financial transactions in appropriate books of account such as journals, subsidiary books, and ledgers. Classification of transactions. Original entry. The journal is the book of original entry, and subsidiary books are classified, grouped, accounting nature, posted in separate accounts known as ledger accounts. Summarizing the transaction, it involves presenting the classified data in a manner and in the form of statements which are understandable by the users. It includes trial balance, trading account, profit and loss account, profit and loss appropriation account, and balance sheet. Analyzing and interpreting the financial data. Result of the business are analyzed and interpreted so that users of the financial statement can make a meaningful and sound judgment. Communicating the financial data or reports to the users. Communicating financial data to the users on the time it is final step of the accounting so that they can make use and take appropriate decisions. It not only record, classified and summarize the business data, but also analyze and interprets the results for their future decisions. This is some chart, the difference between the bookkeeping and the accounting. Accounting starts from the place where the bookkeeping ends. The scope of bookkeeping, it involves identifying, measuring, recording, classifying financial transactions in the ledger, while in accounting, in addition to bookkeeping, accounting also involves summarizing, interpreting, communicating the final data to the users of financial statements. Then objective of bookkeeping, the major objective of the bookkeeping is to maintain systematic records of financial transactions, while the accounting objective is to determine the profitability and the financial position of the business. Then stage bookkeeping, it is a primary stage of accounting. The accounting starts where the bookkeeping ends. Nature of job, it is a routine, repetitive in nature, while in accounting, it is analytical in nature. Level of skill, bookkeeping does not require much or special skill, and it is performed by the junior staff, while the accounting, it requires specialized skill and is performed by the senior staff. System of accounting. There are two systems of accounting. One is double entry bookkeeping system, and the second one is the single entry bookkeeping system. The double entry system is based on dual aspect principle. Every transaction has two aspects, a debit and a credit of an equal amount. The system is accounting recognizes the record both aspects of the transaction. Minimum two accounts are involved. One account which is debited and the second one which is credited. The accounting equation should not be violated. Single entry bookkeeping system, under this system both aspects are not recorded for all the transactions. Either only one aspect is recorded or both the aspects are not recorded for all the transactions. The advantage of double entry bookkeeping system is first, this is a scientific system and is useful to achieve the objective of accounting. It is a complete record of the transaction in each and every transaction recorded, and one can compute profit and loss easily. It checks arithmetical accuracy and accounts records by preparing a trial balance. Determination of profit and loss and depiction of the financial position by preparing profit and loss account. Position of assets and liability is depicted through double entry bookkeeping system. It is helpful in decision making on the basis of factual information. Application of accounting, it provides information about the financial performance. Second, it provides assistance to the management. According to this, assist the management in business planning, decision making, and in exercising control by providing financial information in the form of reports. Then, specialties, comparative study. Accounting helps in making a comparison by keeping a systematic records and preparation of the reports at a regular intervals from the past. It helps in settlement of tax liability. It is helpful in raising loan because the great organizations, they want the book of accounts and analyze on their own the financial statements of the firm, financial institution grant a loan to the firm. It is helpful in decision making. Substitute of human memory. Since it is difficult for a human to remember all the transactions of the business, accounting serve as a substitute of human memory by recording all the transactions and keep all information handy as one requires. It helps in valuation of the business in case of shutdown when the due to strike or in off season or recession when the company is closed. The dissolution of business accounting helps the businessman to determine the value of business. Otherwise, it is not possible to determine value of the business. Limitations. The following are the limitations of the accounting. Accounting is not precise. Accounting is often subjected to personal bias or judgment. Accounting or historic values of assets. Records assets at their historical cost, less depreciation, and does not reflect any current market value. It ignores the effect of price level changes. Accounting statements are prepared at historic cost and thus it ignores the changes in the value of the money. Ignores the qualitative information. Accounting ignores the qualitative aspect as it records only monetary transactions. Affected by window dressing. Window dressing means manipulation in accounting in order to present a more favorable position of the business than the actual position. Then qualitative characteristic of accounting information. Reliability. Reliability means that the information must be free from material error and personal bias. Unless the information is reliable, the accounting records cannot be prepared accurate. Relevance. To be useful, accounting information must be relevant to the decision-making requirement of the users. Understanding ability. Information should be disclosed in financial statement as such a manner that these are easily understandable. Comparability. Both intra-firm and inter-firm comparison must be possible over different time periods. That is, performance of the company can be compared with its previous performance as well as with the other companies in the same trade. Accounting as an information system. Accounting is a social science that can be viewed as an information system. Since it has all the features of a system, it has its input, raw material, then processes, man and equipment, then outputs, reports and information. If we consider accounting as an information system, then we are in a position to make some important observations. First, the goal of the system is to provide information which meets the needs of its users. If we can correctly identify the need of the users, we are then able to specify the nature and character of the output of the system. Secondly, it is the output requirement that determine the type of data which would be selected as the input for processing into information output. There are several groups of people who have a stake in the business, organizations such as managers, shareholders, creditors, employees, customers, government and public at large. Additionally, the community at large and the economic and social interest in the activities of such organizations. This interest is expressed at the national level by the concern of government in various aspects of the firm activities such as their economic well-being, their contribution to the welfare of the society, their part in the growth of the national product, and to mention only a few examples. Shareholders and investors. Since the shareholders, they have invested, an investor, they have invested their wealth in the business and enterprise. They are interested in knowing the periodical profitability of the enterprise, the soundness of their investment, and growth prospects of the enterprise. Historically, business accounting was developed to supply information to those who had invested their funds in the business enterprises. Then creditors may be short-term lenders or long-term lenders. The short-term creditors include suppliers and of the material, goods and services. They are normally known as the trade creditors. Long-term creditors are those who have lent money for purchase of machinery, land and building, usually in the form of secured loans. The main concern of the creditors is focused on the creditworthiness of the firm and its ability to meet its financial obligations. They are therefore concerned with the liquidity of the firm and its profitability and financial soundness. In other words, it can also be stated that creditors are interested mainly in information which deals with the solvency, liquidity, and profitability, so that they could assess the financial standing of the firm. Then employees the harmonious industrial relation between the management and the employees cannot be overemphasized. That the employees have a stake in the outcome of the several managerial decisions in the recognized. Greater emphasis on the industrial democracy through employee participation in the management decisions has important implications for the supply of information. The employees matter like settlement of wage, bonus, profit sharing, and rest adequate decision in relevant facts. Government in the mixed economy, it is considered to be a responsibility of the government to direct the operation of the economic system in such a way that it serves the common good. Control and regulations on the operations of private sector enterprises are the hallmark of the mixed economy. Several government agencies collect information about various aspects of the activities of business organizations. Much of this information is direct output of the accounting system. For example, level of output, profits, investments, costs, and taxes. All this information is very important for evolving policies for managing the economy. The task of the government in managing the industrial economy of the country is facilitated if the accounting information is presented as far as possible in a uniform manner. It is clear that the accounting information is distorted due to the manipulations and window dressing. In the presentation of the annual accounts, it will have ill effect on the measure of the government intends to take the policies it wishes to adopt. The management. In the managerial process, planning, organizing, and controlling functions are concerned. Specific information is required. The emphasis on efficient and effective management of the organization has considerably extended the demand for accounting information. Consumer and others. Consumer organizations, media, welfare organizations, and public at large are also interested in condensed accounting information in order to appraise the efficiency and social role of the enterprise in different sectors of the economy. That is, what level of profit and outputs are being achieved, and in what way the social responsibility is being discharged by the enterprises. Information needs of the various users may not necessarily be the same. Sometimes they may even conflict and compete with each other. In any case, the objective of the accounting information is to enable information users to make optimum use of it and take decisions. Nature of accounting function. The accounting is a service function. The chief accounting executive, by virtue of name it is called, holds a staff position except within its own department where he exerts authority. This is in contradiction of the roles played by the production or marketing executives who hold the authority. The role of the accountant is advisory in the character. He works through the authority of chief executive. He is watchdog for the management and the friend, philosopher, and guide and helper to the juniors. Mutual understanding and rapport between the accountant and the manager in the task of attention directing and problem solving can be enhanced if accountant and his staff frequently interact with each other and guide them in matter concerned with preparation of budgets, control documents, which they might not be in position to do with themselves. Emerging role of accounting. The history of accounting indicates the evaluation pattern which reflects changing socio-economic conditions and the enlarged purposes of which accounting is applied. In the present context, four phases of the evaluation of accounting can be distinguished. Stewardship accounting. In earlier days, the landlord or the owners used to keep their stewards who manage their property and accounts their assets and liabilities, and in the same fashion, they are a sensitive need of the business owners to keep records of their transactions and property and tools they own debt and or the debt of the owner owned by them. The financial accounting, the dates from the development of large scale business and the advent of joint stock companies, a form of business which enables the public to participate in the business organization, permits a limit to the liability of their members to the nominal value of their shares. This means that the liability of a shareholder for the financial debt of the company is limited to the value of their share he has bought. It is the liable, he is liable to make any further contribution in the event of the company's failure or liquidation. As a matter of fact, the law governing the operations functioning of a company in any country, for instance, the Companies Act of India, gives a legal form to the doctrine of stewardship, which requires the information be disclosed to the shareholders in the form of annual income statement and the balance sheet. Briefly, in speaking, the income statement is a statement of profit and loss account during the year and the balance sheet, which indicates the assets and liability of the firm. The importance attached to the financial accounting statement can be traced to the need of the society to mobilize the saving and channel them into the profitable investment. Investor, whether they are large or small, must be provided with reliable and sufficient information in order to be able to make efficient investment decisions. This is the most significant social purpose of the financial accounting. Then post accounting, the industrial revolution in the England presented a challenge to the development of accounting as a tool of industrial management. Posting techniques were developed as guides to the management action. The increasing awareness on the part of the entrepreneurs and industrial managers for using scientific principles of the management in the wake of scientific management movement led to the development of post accounting. Post accounting is the concern with the application of costing principles, methods, and debit, not directly debited as expenses, but part of that is used expenses and the human resource is created. Inflation accounting is concerned with the adjustment in the value of assets, current and fixed, and the profit in the light of change in the price level. In a way, it is concerned with the overcoming of limitations that arise in inflation in financial statements on accounting of the assumption that is recorded in the asset at their. इसमें कुछ आया था इंटरनेट में. Pointed out earlier to safeguard the interest of the shareholders as an independent and impartial appraisal of the financial transactions of the company so that he could report on the net profit earned by the company and its financial position. The controller, the other name of chief accountant, is usually the head of the whole area of accounting, including internal audit. He is overall in charge of the activities comprising financial accounting, cost accounting, management accounting, tax audit, etc. We may enumerate the functions of the controller as follows: designing and operating the accounting system, preparing the financial statements, establishing and maintaining the system, supervising internal auditing, overseeing cost control, preparing budgets, making forecast or analytical report, and reporting the financial information to the top management. This is the treasurer. Difference between the controllership and the treasurer. The finance officer is the lifeblood of the The finance is the lifeblood of the business. Procuring financial resources and their judicious utilization are the two important activities of the financial management. The financial management includes three major decisions: one, the investment decision, financing decision, and the dividend decision. The finance manager has to strike a balance between the current needs and of the enterprise cash and the needs of the shareholders for an adequate return. The financial management of a large company is usually the responsibility of the finance director, who may be in place of or in addition to the controller. The accounting framework. The rules and the convention of the accounting are commonly referred to as the conceptual framework. Accounting, no professional can thrive in the absence of a theoretical framework. Accounting to Henderson 97, accounting theory may be defined as a logical reasoning in the form of set of broad principles that provide a general frame of reference by which the accounting practice can be evaluated, guide the development of a new practice and procedures. The word principle is used to mean a general law and rule adopted the professional as a guide to action, a settled ground or basis of the conduct of practice. This definition describes a principle as a general law or rule that is to be used as a guide to action. Accounting principles are man-made. They are accepted because they are believed to be useful. The general acceptance of the accounting principles usually depends on the law when it meets the three criteria of relevance, objectivity, and feasibility. A principle is relevant to the extent that it results a meaningful or useful information to those who need to know about a certain business. A principle is objective to the extent that the information is not influenced. Accounting concepts. The accounting is the language of the business. Accordingly, it has many dialects. There are differences in the terminology. In dealing with the framework of the accounting theory, one of the confronted with the serious problem arising from the differences in the terminology. So, to take another instance, the idea implied the conservation has been labeled by the author modifying convention, by the author as a principle and yet the another as a doctrine. The concepts are business entity concepts, means the private person and his business will be separate through this concept. In accounting, we make a distinction between the business and the owner. All the records are kept in the form, the viewpoint of the business rather than in the form of that owner. An enterprise is an economic unit separate and apart from the owner or the owners. As such, the transaction of the business and those of the owner should be accounted for and reported separately. Then money measurement concept. In accounting, only those facts which can be expressed in terms of money are recorded, as money is accepted not only as a medium of exchange but also as a store of value. It has a very important advantage since a number of widely different assets and equity are expressed in terms of common denominator. Without these, adding heterogeneous factors like 5 buildings, 10 machines, 6 trucks will not have much meaning. Then, continuity concept. Accounting assumes that the business entity will continue to operate for a long time in the future unless there is a good evidence to the contrary. The enterprise is viewed as a growing concern, that is, as continuing in operation at least in the foreseeable future. The owners have no intention nor have they the necessity to wind up or liquidate its operations. Then cost concept. The resources, land, building, machinery, property rights, etc. that a business owns are called assets. The money values that are assigned to assets are derived from the cost concept. The concept states that an asset is worth the price paid for the cost incurred to acquire it. Thus, the assets are recorded at their original purchase price, and the cost is the basis for the subsequent accounting for the assets. Accrual concept. The accrual concept makes a distinction between the receipt of cash and right to receive and the payment of cash and the legal obligation to pay it. In actual business operations, the obligation to pay and the actual movement of cash may not coincide. The accrual concept recognizes this distinction. In connection with the sale of the goods, revenue may be received before the right to receive arises. After the right to receive has been created, the actual concept provides a guideline to the accountant as to how he should treat the cash receipt and the right related thereto. The concept of conservatism. The concept of conservatism, also known as the concept of prudence, is often stated as anticipate no profit, provide for no possible losses. This means an accountant should follow a cautious approach. He should record lowest possible value of assets and revenues and the highest possible value of liabilities and expenses. The consistency concept. In practice, there are several ways to record an event of transaction in the books of account. For example, the trade discount on raw material purchase may be deducted from the cost of goods and net amount is entered in the books. Or alternatively, trade discount may be shown as income in full cost, raw material purchases entered in the books. Similarly, there are several methods to charge depreciation, maybe straight line method or diminishing method. Periodicity concept. Although the results of operation of a specific enterprise can be known precisely only after the business has ceased to operate, its assets have been sold off and liabilities paid off. The knowledge of the result periodically is also necessary. Those who are interested in the operating results of the business obviously cannot wait till the end. The requirement of these parties therefore force the accountant to report for the change in the wealth of the firm or for short time period. This time period is actual practice vary through a year is the most common. Internal, as it may be a government business year or a calendar year. The accounting standards. The basic concept discussed in the foregoing paras are the core element of the theory of accounting. These concepts, however, permit a variety of alternative practices to exist. As a result, the financial result of different companies cannot be compared and evaluated unless full information is available about the accounting methods which they have used. The variety of accounting practices have made it difficult to compare the financial results of different companies. Changing nature of generally accepted accounting, GAAP. Generally accepted accounting principles are usually developed by the professional accounting bodies like American Institute of Certified Public Accountants and Institute of Chartered Accountants of India. In developing such principles, however, the accounting professions has to reflect the realities of social, economic, legal, and political environment in which they operate. Besides, academic research, regulatory and tax laws of the government, etc., Companies Act 1956, Income Tax Act 1961, etc., in a large measure influence the formulation of the acceptable accounting principles. Stock Exchange and other regulatory agencies like Securities and Exchange Board of India have laid down rules for disclosure of extant accounting information. Unit to preparation of books of account. Business enterprises generally prepare the following books of financial statements, profit and loss account to ascertain the profit earned or loss incurred during the accounting period, balance sheet to ascertain the financial position of the business as on a particular date. Cash flow statement. Generally, a business enterprise has numerous transactions every day during the accounting period. The cash from where it has come to the business and where it has been used is to be verified from the cash flow statement. The accounting process involves the following steps and stages: economic event, business transactions, then transaction analysis, assets, liability, capital, revenue, expenses, then record the memorandum or rough work in the waste book, then journalizing journal entries, book of transaction in book of original entry, then posting in the ledgers, preparation of trial balance, then preparation of trading account, profit and loss account, and the other financial statements like balance sheet, passing of the reverse entries. If there is some wrong entry, then it can be reversed, and the final presentation of the accounts. Accounting processing involves the following steps: identification of transaction. In accounting, only the business transactions are recorded. Recording of transactions. Journal is the first book of original entry in which the transactions are recorded. Then classifying, then accounting. After classifying the entry, it is posted in the journal. Then summarizing, the art of making the activities of the business enterprises classified in the ledger for the use of management and the other groups, sundry creditors, etc. Summarization help the preparation of profit and loss account and the balance sheet particular. Analysis and interpretation. The financial information or data as recorded in the books of an account must further be analyzed and interpreted so that to draw the useful conclusion. Then presentation or reporting of the financial result. The end users of the accounting statement must be benefited from the analysis and presentation of the data. Some of them are stockholders or shareholders, and the other one are the comparison of past and present statement and reports. Use the ratio, trends analysis, and different tools for analysis and interpretation. Analysis of business transaction. Accounting process starts with the business transaction and is followed by analysis of the transaction for the purpose of classification and recording of the transaction. Voucher. The voucher are of two types: the debit voucher and credit voucher. Credit voucher is used for the credit entries, and debit voucher is used for payments. And and the another voucher is the transfer voucher, in which the amount is in the cash is not used, amount is transferred from one account to another. Either one account is debited and another account is credited. And overview of balance sheet. The balance sheet, with the help of an example, Mr. Raghav is the owner of a startup RT. On 1st April 2020, the position of the business RT, he invested his personal rupees 10 lakhs cash capital to start the business. He took a loan of rupees 3.5 lakhs by buying an office and premises. Further, he purchased some machinery for rupees 2 lakhs, motor car in 3 lakhs, operates in the firm to start business operations, bought inventory 2 lakhs 50,000, kept 20,000 at cash and 50,000 in saving bank. So this is the format of that balance sheet. In left side, the liabilities are mentioned. In right side, the assets are mentioned. The capital, he has brought 10 lakhs, and the loan taken from bank 3.5 lakhs. These two are liabilities. The total of liability side is 13 lakh 50,000. In asset side, the machinery 2 lakhs, building office premises 3 lakh 50,000, motor car 3 lakhs, investment in bonds 1 lakh 80,000, inventory 2 lakh 50,000, cash 20,000, saving bank account 50,000. The total of the asset side is 13 lakh 50,000. Here we can see the total value of resources owned by the RT Limited, which includes building, machinery, car, cash, investment, and inventory, is worth rupees 13.50 lakhs. Accounting these resources owned by the business are referred to as assets. Further, we observe that the claim against these resources in the form of bank loan 3 lakh 50,000. Such claim against business entity assets is referred as liability, and the capital brought by the owner of RT Limited, rupees 10 lakhs, is also liability. Then the classification of accounts. Accounts are of two types: personal and impersonal account. Personal accounts are further classified as natural personal account, artificial personal account, and representative personal accounts. The impersonal accounts are real accounts and nominal accounts. Again, in reals, the tangible real and intangible. The natural accounts are those in the name of person, like Mohanlal, Sohanlal. Then artificial personal accounts are those accounts which are in the name of firms, and representative accounts are like the wages due account or the insurance due account. Then the real account and the nominal account. Real accounts are those tangible accounts like fixed assets, land and building, machinery. Intangible accounts are those like goodwill and patents, those do not have physical force. The nominal accounts are those which are used in the business, like uh, earning accounts and expenses accounts. Earning accounts are those interest, exchange, commission, and expenses account are those in which expenses are debited, like charges account. Now, the rule of to debit and credit. Types of account. Personal account, the rule is debit the receiver and credit the giver. Real accounts are those which shows the debit balance in the ledger. Debit what comes in, credit what goes out. If something is coming to the business, that is debited to that account and shows red balance. When it is sold off or some depreciation is created, then credit what goes out. The nominal account is debit all the expenses and losses, credit all the income and gains. Dual aspect concept. Suppose Mr. Raghav purchased some goods or raw material worth rupees 10,000 in cash. Then transaction we will have to dual impact. The goods account or the raw material account will show a increase and the cash will show a decrease because cash has gone out and the raw material has come in. Similarly, assets are assets is equal to liability and owner's equity. The accounting equation indicates an increase in the asset is followed by increase in the liability, or equity vice versa. Then a decrease in the asset is followed by decrease in the liability. Then increase in an asset is followed by decrease in another asset. Suppose we have purchased a raw material, then by cash, then cash will be decreased and raw material will be increased. Then increase a liability followed by a decrease in another liability. Here an example, Mr. Raghav further invested rupees 4 lakhs into the business RT Limited. With effect of this transaction will be capital will be increased by 4 lakhs and the cash will also increase by 4 lakhs asset side. And Mr. Raghav repaid the loan in cash to bank in office building 3.5 lakhs. Then the liability will be decreased by 3.5 lakhs. Similarly, the cash will also decrease by 3.5 lakhs. Now, accounting equation approach. The basic accounting equation is assets is equal to liability plus capital. In the equation, assets refer to the resources owned by the business enterprises, and these resources are expected to generate future cash flows and earnings for the business. Liabilities are claimed, on the other hand, on the assets of the business, or in simple terms, it is the debt, outstanding expenses payable to the various stakeholders. When we use accounting equation approach for recording business transactions, all these are divided into 3: asset account, liability account, and capital account. Now the transaction, this is a live example. Transaction analysis, nature of account, rule and entry. Introduction of rupees 5 lakhs in cash by the owner in the business. So the cash balance will increase. Analysis as in the asset side. Similarly, debit increase in assets, debit cash account. Then increase in liability, capital account will increase by 5 lakhs, the capital, credit increase in capital, credit capital account. Accounting illustration of analyzed transaction of Mr. Sunil and Company for the month of March 21 on the basis of double entry system by adopting the following approach: accounting equation approach, traditional approach. Transaction for the month of March 21 were as follows. Sunil introduced a cash of rupees 40,000, cash deposited in the Citibank 20,000, cash loan rupees 5,000 taken from the Y, salaries paid for the month of March 21 rupees 3,000 and 1,000 are still payable for the month of March 21. Furniture purchase rupees 5,000. What conclusions are can drawn from the above analysis? Analyze the business transaction, accounting equation approach. Now this is the example, transaction introduction 40,000, cash received, so debit cash. Then the double entry system, this cash will go to capital, so capital will increase. So the cash deposited in the bank, so bank balance increases, cash balance decreases. So create cash account and debit bank account. From Y, cash asset debit rupees 5,000 increase creates obligation of 5 to repay. Y's loan liability increase in the asset, create increase in the liabilities, create Y loan account. Then salary is paid 3,000 and outstanding 1,000 to debit salary account 4,000 and create cash account 3,000. Create salary account 1,000 and outstanding account 1,000. Furniture purchased 5,000, then furniture account debited and cash account created. Similarly, the other transactions introduced. Illustration 2 show the classification of the following accounts under traditional and accounting equation approach: building, purchase, sales, bank deposit, rent outstanding, cash, adjusted purchases, closing stock, investment, debtors, and all this depreciation account, interest receivable account, rent received in advance, prepaid salary account, bad and doubtful debt account, stock reserve account, provisional account on creditors account. This is the nature of account: building, real account, an asset; purchases, real account, asset; sales, nominal account, revenue; temporary capital, bank deposit, asset; rent, temporary capital, expenses; rent outstanding is liability; cash is the asset, real asset; adjusted purchase, temporary capital; closing stock is the asset; investment is the asset. Then sales tax payable liability, discount allowed, temporary capital; bad debts is temporary capital; capital personal is the capital; drawing, temporary capital; provision of depreciation asset; interest receivable asset; rent received in advance liability; prepaid salary valuation as asset; provision for bad and doubtful valuation as asset; bad and doubtful recovered, this is temporary capital; depreciation, temporary capital expenses; personal income tax, temporary capital; drawing, stock reserve valuation asset; provision for discount creditors valuation liability. The journal is the historical record of business transactions. In the event the word journal comes from the French jour, meaning day. It is the book original prime entry. Journal is primary book for recording the day-to-day transactions in the chronicle order, the order in which they occur. The journal is in the form of diary and business transactions. This is called a book of first entry, since every transaction is recorded firstly in the journal. Journalizing is the process of recording journal entries in the journal. It is the systematic act of entering the transaction in the daybook or order of the occurrence, date-wise, event-wise. After analyzing the business transactions, the following steps of journalizing is followed. Find out what accounts are involved in the business transactions. Ascertain what is the nature of accounts involved. Ascertain the golden rule of debit and credit is applicable for each of the account involved. Find out what account is to be debited, which is to be credited. Record the date of transaction in the date column. Write the name of the account and debited every near and left hand side particulars column along with word debit on the same line against the name of account in the particular column, and the amount is debited in the debit account column against the name of the account. Record the name of the account to be created in the next preceding year and word to be towards the right particular column, and the amount is created in the credit account column in front of the name of the account. Record the narration. Goods account is generally termed the goods account, include the type of property such as land, building, machinery, furniture, cloth, and raw material. However, the accountancy is meaningful restricted to only those articles which are purchased by a businessman with the intention to sell it. For the example, if the business purchased typewriter, it will not be sold. It will be the goods for him which deals in typewriter but deals in the other business. Say clothes, then writer will be asset for him and clothes will be goods. Subdivision of the goods account. The goods account is not opened in the accounting books, and it is noted the goods include purchases, sales, sale return, purchase return of the goods. However, the purchase account, sales return account, and the purchase return account are opened in the book of account. Purchase account is opened in the goods purchase of cash and credit. Sales account, this account is opened in the goods sold in cash and credit. Purchase return account. Opening entry. In the case of going concern, at the beginning of the new year, the new books of account are opened and the balance relating to the personal and real account appearing in the books at the close of the previous year are brought forward in the new books. The entry of this purpose in the accounts is called opening entry. Assets is equal to liability plus capital, and capital is equal to assets minus liability. The important considerations are trade discount. The trade discount is usually allowed on the list price of the goods. It may be allowed by producer to wholesalers and the wholesalers to retailers for purchase of goods in large quantity. It is not recorded in the books of account as entry is made. Suppose the goods are purchased, price of list is rupees 8,000 at the rate of 15% trade discount X, and the case of the following entry will be passed. For example, X owes this 6,000 to Y. He pays rupees 5,915 full settlement against the amount due. The X journal entry will be rupees. Okay, thank you. Hmm.